This is question 4 from quiz 3. This is, in my opinion, a pretty long question, but if you take it, I don't know, line by line, then you do okay. So we're following Tesla. We're trying to figure out what it should be worth. And we have some revenue projections, some operating expense projections, some depreciation. We have a tax rate. So it looks like, and this is a stock question. So we want to use the free cash flow approach. The way that you would get started on this if you didn't know what to do would be to just start creating the income statement. So let's do that now. I'm going to drop down a little bit when I do it because I feel like we need the room for the growth rates. So revenue is going to have a growth rate. And sometimes these questions don't have growth rates, but or like there'll be some other assumption, but this one does. Okay, so we start at 24 billion and we grow 8% per year for 9 years. That looks good. Operating expenses start in at 27. They grow for 3% for 4 years and then 1% after that. Now I've already forgotten the 27. And I think we said 3 and 1%. All right, for 4 years. So technically, I guess this is 1 through 5. And this is 6 through 10. And I got that from where it says in the problem for the next 4 years. So 1, 2, 3, 4. And here we're going to switch to 1%. Oops. Times. Okay. This will give us EBITDA. And let's put a line at the bottom. We now have depreciation. And if you drop down here, this whole thing is about depreciation. So it basically says it's going to be $2 billion a year from 1 to 10 years, and then we're going to spend $15 billion on a factory. We're going to ignore that for now because that's CapEx. We'll put that in the bottom. But then depreciation expenses will increase by $3 billion during the years 8 through 10. So 2 and then 5. So that means EBIT now we got to pay taxes. Oh, we need a tax rate. Oops. Our tax rate, I think, is going to be 21%. So our taxes are going to be that. Now, somebody asked me can you pay negative amounts of taxes? And why should you pay taxes when you have negative income? I'm just going to call this profit. The question of paying taxes is a little tricky because in reality you would have some clever accountant, and the clever accountant would be doing all kinds of weird stuff to save you money, and therefore taxes would be something that would not be this simple to calculate. We are using this for our NPV calculation. Just do 25% times whatever EBIT is, or 21%. Okay, so now we got to calculate free cash flow. So we're going to start out with our profit. we are going to back out, well, let's do working cap, the working capital amount, and let's do gain or loss in working capital. We need to factor in depreciation, and then we need to factor in capital expenditures. And then once we're there, we should be able to calculate free cash flow. Okay, the profit is just going to be this. Oops. The working capital, here it is. We have working capital of $5 billion, and we increase that it's going to, or we project it's going to increase 7% per year. Okay, so we start with fives, and it increases 7%. So that means that if I need 535 in year one, and I only had 5 last year, then I need to add 0.35 or 350 million. The depreciation, we're just going to reference the top cell, copy it across, and then we spent 15 billion on a battery factory in year 7. Year 7 is here, 15 is here. Let's draw our line. Our free cash flow is going to be our profit minus our contribution to working capital plus our depreciation minus our capital expenditures. The last thing that we need to think about is what the terminal value is at the end of the projection. And so in here, where does it say it? Tesla's cash flows will grow after year 10 by 3% forever. So what we can do, this would be our terminal year. So that means that our terminal value is, let me add our discount rate. That's from the problem, 0.085. Let me make that clear that it's, okay. So our terminal value is going to be this divided by 8 minus 0.03. Notice that we are not including year 10 because our terminal value is already assumed in there. Okay, so we can get the PV of these cash flows. You can use the PV formula or NPV formula if you want. I'm doing this so you guys can see how the numbers work. All right, I think all the references are correct. All right, so the firm, according to our calculation, the enterprise value is 118 billion. I'm going to drop down and do this. Enterprise value is that. We have debt outstanding of 20 billion, so that means that the equity value is going to be this minus that. It says that we have 185 million shares outstanding. Well, this is in billions, so that means that the shares outstanding is going to be 0.185 because 185 million is 0.185 billion. So that means the price per share is going to be this divided by that, and let me just highlight it, $530.19. And that is the answer to the question here. Um, the trickiest thing here, in my opinion, is just making sure that you follow every single bit of the instructions exactly as they are written on the page and to get the terminal value right. The last thing would be to figure out 0.185 in terms of millions or billions. You could convert this into billions and multiply it by a billion out here and then divide by 185 million. You don't have to do that. It will work if you do it this way. But that's the answer, and that's how you get to it.